Hello guys, finally welcome to my first long video. This is the Crash Investor. Today we're going to talk about the topic which many of you requested in the comments, the holdings of my dividend portfolio, the reasons why I chose them, and what are the strategies that I'm using and the reasons why I started this channel. Let's talk first about the main goal of my channel. Have you ever felt that in order to start investing you should have large amounts to begin with and you would rather wait until you have hundreds of dollars to start investing? That's why I'm here, guys. I'm here to encourage everybody to start investing, even if you just have as little as $1 a day. Whether you're a 19-year-old who just got their paycheck and has no idea where to start and how to start investing, or you're an adult who has a lot of bills to pay and at the end of the day you're left with little to no money. You're also struggling to save some because you don't believe in investing with small amounts of money, or you just feel like it's not worth it. I'm doing this experiment to show you the power of compound interest. I want to help you reach your financial goals and find the best way to do it, and eventually reach your financial freedom through the power of dividend investing. This is why I decided to start this portfolio and document my journey. Hopefully one day I can help somebody out there in reaching his destination. Currently I'm investing $5 a day into my dividend portfolio, and I divided my portfolio into 4 different portfolios. Each one utilizes a different strategy and has different holdings to help you find which holdings that might work for you based on your financial goals and time horizons. So I will put money in all of these strategies and we will see how the results will turn out to be. The main goal of this channel, guys, is to prove that now is the best time to invest. Unless you've been living under a rock, I'm sure that you know that at the moment we are in stock and crypto crash. Do you know what most of the people do when we're in a bear market? They try to get out of the market even at a loss. But do you know what we should be doing in this kind of markets? We should take advantage of it and buy everything on a discount. This way your money will get you more shares for less. That's why I am the Crash Investor. I'll show you how this crash will help me get even greater results in the long run. Now, enough of the talking, let's crash invest and let the time do the rest. Let's check the first portfolio, guys, my soldiers. And I'm sure you're wondering why it's called like this. Well, it's because these ETFs are going to fight on my behalf to help me accomplish the earliest date of retirement. This portfolio looks a lot like my main portfolio. This portfolio has 4 different ETFs and an average dividend yield of 8.58%. This means for every $1,000 you invest in this portfolio, you'll get $85 in annual dividends. This portfolio isn't for everybody, especially if you have a long time horizon. This portfolio is designed for people who are retired or near retirement, people who are seeking early retirement, people who need a higher than average yield to help them pay some bills. Make sure to stay till the end of the video where I'll be comparing this portfolio to some other benchmark portfolios. Anyways, always remember that past performance won't predict the future returns. The first ETF on our list is Amplify CWP Enhanced Dividend Income ETF, ticker symbol divo. In the past year, where the SPY was down 19.68%, this ETF only dropped down 5.98%. The thing that I really like about divo is the tactical covered call strategy on individual positions instead of the entire index, so this won't limit its upside potential. The dividend yield at the moment is 4.76% and the expense ratio is 0.54%, which usually I consider it to be on the expensive side, but it's totally justified by the outstanding performance in this recession and the dividend yield. By taking a look on the top 10 holdings, we can immediately realize that all of its stock holdings are well established and mature companies that can withstand market volatility and generate solid returns in bull markets. These companies are considered among the best dividend payers in the large cap category. This gives me more confidence to believe in their strategy and makes having an ETF like this a must in these types of portfolios. Divo is going to add some share price appreciation into this portfolio and will add more stability and less overall volatility in combination with other ETFs and will help boost the average dividend yield of the portfolio, as well as maybe it will add a little bit of dividend growth. But I'm not depending on Divo to do this part, because the payments of covered calls ETFs fluctuates a lot depending on so many factors. In terms of allocation, it's going to be 20% of my portfolio, and I think this will complement the other ETFs. Of course, in order to reach 8.58% in dividends, you will need a covered call ETF that yields in double digits, so there's no ETF better suited to do this than JP Morgan Equity Premium Income ETF, ticker symbol JP. JP quickly became one of the best dividend ETFs and a favorite for so many investors because of its ability to generate large amounts of monthly income for its investors. Currently has a super high dividend yield at 11.68%. In fact, JP is my favorite dividend ETF on the market, and if I had to buy only one ETF, I think it would be JP. This strategy is generating reliable dividends exceeding the current inflation. Over the past 12 months, the share price has gone down 13.6%, yet it managed to outperform most of the traditional index funds and the global X funds family. JP generates income from ELNs instead of writing covered calls on its positions, so its upside potential is not limited. Looking at its top 10 holdings, we can see so many large cap, well-established companies. Some of them have been paying dividends for decades. This makes JP a suitable addition for the portfolio because of its ability to drive so much cash flow and has competitive returns, JP is going to be responsible for the high income part in the portfolio. To be honest, what JP is doing in the past year is extremely respectable and makes it a must to have it in any income focused portfolio. This is why JP will make 40% of this portfolio. The next ETF in this portfolio is JP's younger brother JPQ, the JP Morgan Nasdaq Equity Premium Income ETF that is currently sitting on a 9.44% dividend yield. It's using the same strategies as JP. It's also using ELNs to generate the high amounts of cash flow each month. In this downtrend market, JPQ lost around 20% of its value, so it's more volatile than JP. It's due to the underlying assets of this ETF, which follows the tech-heavy Nasdaq index, but this also gives it more room to grow and outperform JP in the bull market in terms of share price. The main reasons to invest in JPQ is having the same winning strategy that JP utilizes, doing its job on even more different holdings. If we just take a look on the top 10 holdings of these two ETFs side by side, we can see the big tech names that JPQ will give you exposure to, like Microsoft, Google, Apple, Amazon, Nvidia, Meta, Tesla, and to be honest, everybody wants to hold some of these names. While JP holds companies like ExxonMobil, Coca-Cola, Pepsi, United Health Group, and the Hershey's Company. And if we check the overlap between these two ETFs, we can see that there are 35 overlapping holdings, which makes this, in addition to the super high dividend yield that will generate even more cash flow into this portfolio and having some more upside share price potential, a valid reason to add this ETF at 20% allocation of the overall portfolio. Of course, dividend growth is not expected from JPQ and its older brother JP, due to their methods of generating income. For sure, making the perfect quadfecta won't be complete without the dividend growth part of it. The part that will help to compensate of all the volatility in the dividend payments of all the other ETFs. Without a second thought, there is no dividend ETF better than schg. This ETF is crowned the title of the best dividend ETF in the world. This ETF will add even more diversification to your portfolio by giving you exposure to Lockheed Martin, one of the best dividend companies on the planet, and in addition to Pfizer, Home Depot, and Verizon. There's nothing better than seeing your investment grow in every aspect and pay you even more money as time goes by. Its 5-year growth rate is 13.74%. Its share price is down 6.41%. And at the moment, the dividend yield is 3.39%. So in a nutshell, schg is going to add some dividend growth and capital appreciation, also giving the portfolio more diversification. Now let's compare this well-diversified income-focused portfolio to the famous original quadfecta portfolio. The original quadfecta had a higher dividend yield at nearly 10%. Looking at the expense ratio, the new one is cheaper at 0.33%. The performance is where the new one shines. We can see that it's only down 8.71% in the past year in comparison with 21.13% of the original. And there's one more point. It's really hard for the original to recover from this because the upside potential is so limited while the newer one have way more upside potential and maybe some dividend growth. If we compare the new one with the simple growth portfolio, we can see that this one was down 26.33% in the past year. The only downside of this portfolio is the low dividend yield at 1.18%, which is not so good for someone who's not planning to sell some shares to support the income. So now why don't we compare this to the high yield portfolio that we have? That one has about 15% dividend yield and 0.43% expense ratio, and it went down 24.2% in the last 12 months. That was it for this video, guys, because I don't want to make it an extremely long video. So make sure to subscribe and turn on the notifications so you don't miss the next part of my portfolio reveal.